Coming in from the management of Kaynes Technologies. But while we're talking about the company has been on our radar for some time, and here's a bull versus bear case that Srishti is joining us to break for us and give us the analysis on both sides of the coin. Srishti.
Well, yes, absolutely. Kaynes Technologies, a classic battleground stock right now, with the street sharply divided between the bulls and the bears. So firstly, let's tell you the concerns that were flagged off with respect to the bear strategy. Because of that, we are seeing such a sharp fall in Kaynes Tech of late. But we'll also tell you the kind of clarification that we have got from the management. Let's break it down point by point. Firstly, with respect to the smart meter contribution, this is one of the new segments for Kaynes Tech, have been contributing significantly. The margin profile is quite higher, and over there we have seen some working capital concerns, because working capital on an overall basis did shot up to 116 days in the first half, significantly higher than the overall working capital of FY25, and that's because of the higher smart meter contribution. But the management clarified that the mix out will drop sharply in the second half, which should naturally bring the working capital and the receivable is lower in the second half. But how will that be? How will the management do that? Because the other concern that was flagged off in the H1 financials was the receivables and the customer profile, wherein it was highlighted that the receivables have actually doubled, and that has strained the cash flows in the first half of this fiscal. But the management did say that with respect to the smart meter segment, they will not be servicing the customers, and they will definitely be providing the smart meters, but service as a whole is not something that they will be focusing going ahead. One of their key clients is actually a government client, which is PGCIL, and Kaynes is exiting the AMISP model, that is the service model, meaning this long cycle pattern won't repeat. Now, the other concern was the contingent liabilities. Now, there's a worry that the contingent liabilities did jump to almost 210 crores in terms of the guarantees. But on that, the management did say that this spike is largely tied to the legacy Iskarmiko projects and isn't expected to materially rise from here on. And that's what some of the brokerages are also believing. Then comes the R&D expense. Now, there's the concern that it's on the higher side, which is of a high level of capitalization. But on that, the management argued that the large ODM programs like Kavach will start delivering the revenues, and expenses will normalize going ahead as these projects scale up. Now, when it comes to Kaynes Tech as whole, the company, smart meters is not the only segment. The company is present in some of the other segments as well. Yes, smart meter growth will be on the slower side. The contribution will come lower. But some of these brokerages do believe that going ahead, the autos, EVs, industrials, and the railway segment, they are already picking up, setting up a strong second half rebound is what the brokerages are believing. Now comes the verdict. The brokerage and the street is indeed divided. It comes to Kotak, because Kotak was the one to flag off all these concerns from their annual report. For today, they have come out with a note, maintain their reduced rating, and once again slash their target price to 4,150 rupees. While JP Morgan on the other side, after all the clarification that has come in, they did not change their stance, and so is the target price. They still remain overweight on Kaynes Tech with a target price of 7,550 rupees. So that's a bear versus bull scenario. So overall, it's a classic split screen. Back to you.
Thank you so much for that, Srishti. With regard to Kaynes Tech and